All right, let's just dive right into this explainer because honestly, the signals hitting the trading floor this week are, well, they're wild. As a financial expert, I'm looking at our current market stability and corporate growth, and it's like we're watching two totally different realities playing out at the exact same time. On one hand, record-breaking highs. On the other, historic pessimism. So we're going to break down exactly what's driving this wedge, what it means for the big corporations, and most importantly, how you can navigate it. Right out of the gate, check out this number. The U.S. economy added a massive 115,000 jobs in April. I mean, that completely blew past analyst expectations. They only penciled in about 55,000. We're seeing real gains across retail, transportation, warehousing, healthcare, the whole shebang. What this tells us is that businesses are actually stabilizing. They're weathering the recent tariffs, and the labor market, it's showing this incredible, stubborn resilience, even with the ongoing war in Iran.
And you know, that resilience, it fueled an absolutely blistering tech rally on Wall Street. The Nasdaq Composite just surged up 4.5%. That is its largest 6-week percentage gain since all the way back in 2009. Plus, the S&P 500 is sitting right at a record high. Honestly, if you just look at these numbers, you think the economy is firing on all cylinders and everyone's popping champagne.
But here is the catch. Paradoxically, the University of Michigan's Consumer Sentiment Index has plummeted to a historically grim 48.2. Analysts thought it holds steady around 49.7, but nope, it dipped even lower. To put that into perspective, this reading is actually worse than during the surging post-pandemic inflation we saw in 2022. Everyday consumers are really feeling the weight of inflation, soaring gasoline prices, and some pretty deep geopolitical fears. So this brings us to Section 1, the Great Market Disconnect. Main Street pain versus Wall Street gains. Now, the central paradox of our current economy is playing out right here in real time. On the macro side, we've got an incredibly solid economic backdrop. Think about it, 115,000 jobs added, extremely low jobless claims sitting at just 200,000, and surging corporate AI investment that is literally boosting our national GDP. But collide that head-on with darkening household perception. People are feeling the direct squeeze of tariffs and surging gas prices tied to the Middle East conflict. So the macroeconomic data is flashing green, but the actual household reality, deep red. Diane Swank, chief economist at KPMG, hit the nail on the head here. She says, those who have a job are clearly clinging on, while those looking for a job are feeling frozen out. That brilliantly illustrates the stagnation beneath the surface. Yeah, we have a low 4.3% unemployment rate, but it hides a labor market that's completely frozen. The low pace of firing means if you have a job, you're gripping it tight. But if you're out there looking, the doors are just shut. It's this weird, stagnant stability. Moving on to Section 2, Tech and AI drive growth, the engine pushing the market to record highs. Okay, a massive bombshell hit the wire recently. Apple and Intel reached a preliminary chip manufacturing deal. And wow, this sent Intel's stock rocketing 14% in a single day, pushing its market cap to nearly $630 billion. I mean, compare that to roughly $92 billion just a year ago. It's practically a vertical climb. The really crucial point here is the staggering scale of this AI boom. Just look at April. Semiconductor stocks saw a 38% rise in that month alone, their best month since February 2000. And Alphabet, they gained 10% on April 30th. That added over $421 billion in market value in a single day. Let that sink in. That is the second largest one-day gain for a stock in history. And this momentum, it's building across the entire broader tech ecosystem. It's not just the chip makers like Intel or the mega caps like Alphabet. The infrastructure plays are seriously cashing in. Akamai Technologies jumped 27% on a $1.8 billion AI cloud deal. The Magnificent 7 ETF just hit its first new high since October. And, maybe most importantly from a macroeconomic perspective, the U.S. Q1 GDP was fundamentally boosted by business spending on AI. This is not just hype, folks. It is translating into hard, measurable economic growth. Which leads us to Section 3, corporate pivots and headwinds, looking beyond the AI hype. Because when we look across the broader equities market, traditional giants are facing massive geopolitical and technological restructuring. It's a very mixed bag. Take Toyota. They just reported a fantastic 23% jump in net profit, right? But they're projecting a 22% drop next year because of the toll the Middle East conflict is going to take on their supply chains and energy costs. Then you've got Commerce Bank. They're lifting financial targets, sure, but having to slash 3,000 roles to fend off a hostile takeover from UniCredit. And then there's the advertising giant WPP. Their stock is down roughly 30% because they're stuck playing a really expensive game of AI catch-up against automated ad systems from Google and Meta. And, the pain isn't just in the boardroom. It's literally at the drive-thru. Even fast food is feeling the pinch of that grim 48.2 consumer sentiment we talked about earlier. Wendy's saw a harsh 7.8% drop in U.S. same-restaurant sales in the first quarter. When the everyday consumer is getting squeezed by gas prices and inflation, discretionary spending, like, grabbing a quick burger, is usually the first thing to get cut. All right, Section 4, commodity volatility. Cocoa surges and oil drops. Now, in a complete defiance of expectations, Brent crude oil has surprisingly dipped down to around $101 a barrel. That's a 6.4% drop for the week. And this is happening despite U.S. forces striking Iranian-flagged oil tankers. The economic consequences traders feared from this conflict just haven't fully materialized in the crude market yet. But meanwhile, cocoa futures are surging wildly. Speculators who bet against cocoa are being absolutely crushed by violent short squeezes. They're being forced to buy back contracts to cover their bets, which of course just sends the price rocketing even higher. It is a wild ride. So, on to Section 5. Are we in a bubble? Let's analyze our market stability. As a financial expert evaluating all of this, the massive elephant in the room is whether this disconnect means we are actually in a bubble. To answer that, portfolio manager Owen Lamont gives us this brilliant analytical checklist to evaluate systemic stability. He calls them the 4 horsemen of a bubble. He says you don't just need high stock prices. You also need a culture of attacking critics, a massive wave of new stock issuance, and blind performance chasing by retail investors. So let's run today's market through this framework. The results are actually pretty fascinating. High prices? Yes. Obviously, the indexes are sitting at records. Attacking critics? No, not really. We aren't seeing that toxic 2021 Bitcoin or meme stock level of lashing out at skeptics. An issuance wave? Not yet. IPOs haven't exactly been flooding the market, though, full disclosure, we are watching giants like SpaceX and Anthropic closely to see if that changes later this year. And finally, performance chasing? Surprisingly, no. Individual investors have actually been buying stocks on bad news about tariffs or war. As Lamont perfectly puts it, a bubble is by the rip, not by the dip. What this signals to the market is that current retail behavior is actually contrarian, not irrational exuberance. We are currently lacking the manic IPO flooding and the blind trend chasing that typically define a true systemic red zone bubble. So, what do you actually do with all this information? Well, the key takeaway for your portfolio defense right now is to remember that stocks are not a toggle switch you just flip on or off. You need to stay actively diversified. Look beyond the S&P 500. Make sure you have exposure to smaller caps and international stocks. And crucially, look at trimming some of your massive tech wins to rebalance and really manage your risk. I'll leave you with this provocative thought. The macroeconomic data says we're booming, but the American consumer says we're hurting. As this disconnect between Main Street and Wall Street widens, are you positioned to survive the collision? Think about your portfolio tonight, and I'll catch you in the next explainer.